The supply of Bitcoin on exchanges and OTC desks has been on a steep decline. At the same time, the demand for Bitcoin by investors who are bullish, like Strategy, has continued to rise. Now, many believe that this sets the stage for the so-called supply crunch, wherein a shortage of available Bitcoin causes its price to go parabolic as big buyers continue to accumulate. And that's why today we're going to explain exactly what a supply crunch is and examine how likely it is to happen, when it could happen, and how it could affect the Bitcoin price and the broader crypto market. My name is Nick. Stay tuned. In case you missed it, a supply crunch is when the supply of an asset starts to decline while the demand stays the same or even increases, causing the price to spike. And this is why a supply crunch is also sometimes referred to as a supply shortage or a supply squeeze, and it's actually something that's happened before. If you watched our recent video about the silver market, you'll know that it experienced a supply crunch in the 1980s. The TLDR is that three billionaire brothers called the Hunt brothers accumulated close to 1/3 of silver's liquid supply, causing its price to pump. When other investors started piling in, silver went parabolic. Believe it or not, but we're seeing almost the exact same thing happening today with Bitcoin. According to the Bitcoin Treasury's website, ETFs, countries, public companies, private companies, Bitcoin miners, and DeFi protocols collectively hold more than 15% of Bitcoin's total supply of 21 million, which is pretty wild when you think about it. The craziest part is that just like silver during the 1980s, not all of the Bitcoin in circulation today is liquid. In plain English, not all the Bitcoin in circulation is tradable. For starters, only around 20 of the 21 million Bitcoin are in actual circulation, and another 4 to 6 million Bitcoin are estimated to be lost or otherwise inaccessible. What this means is that there's only 14 million Bitcoin that's technically in circulation. Now, for context, ETFs, countries, public companies, and others hold just over 3.2 million Bitcoin. To be on par with the Hunt brothers in the 1980s, they would need to purchase another 1 million Bitcoin to control 1/3 of the supply. However, it's possible that this threshold has already been exceeded. According to Glassnode, only around 5 million Bitcoin is liquid or highly liquid, with the rest being illiquid, either because it's been lost or because it's been hodled. In theory, this means that ETFs, countries, etc., hold 2/3 of Bitcoin's liquid supply. Yet, in practice, one could argue that the Bitcoin held by spot Bitcoin ETFs also counts as being liquid, simply because we've seen the ETFs buy or sell Bitcoin based on market conditions. One could even argue that the Bitcoin held by governments is also mostly liquid, just because we've already seen some governments dump their Bitcoin. Germany. However, even if we do assume that most of the Bitcoin held by ETFs and countries is liquid, public companies, private companies, Bitcoin miners, and DeFi protocols still collectively hold close to 1.5 million Bitcoin and counting. Not only that, but many of these entities continue to buy and hodl Bitcoin. Lo and behold, 1.5 million Bitcoin works out to 1/3 of Bitcoin's liquid supply. In other words, no matter how you slice it, it looks like Bitcoin is on track to experience a supply crunch that could send its price parabolic in the coming months, like silver in the 1980s. The only questions are when and how much could it rally by? My only question is why you're not subscribed to the channel yet. We've noticed that at least 36% of the people who watch these videos are not subscribed to the channel. So if you're enjoying this video so far, help others find it by pumping those numbers up. Subscribe to the channel, ping the notification bell, and fire up those likes, please. Back to the video. Now, before we answer the questions of when the Bitcoin supply crunch could happen and how high the Bitcoin price could go, there's a bigger question we need to address, and that's why it hasn't happened already. After all, public companies have been buying billions in Bitcoin, so why hasn't BTC pumped more? The answer is interesting. It's essentially because of the disconnect between the big buyers and the sellers of this Bitcoin. You see, most large Bitcoin buys take place over the counter or OTC. For example, Strategy will buy 1,000 Bitcoin directly from a crypto exchange like Coinbase rather than on the open market. The fact that this purchase takes place directly between two entities means that the direct impact on Bitcoin's price is minimal. To be clear, these purchases still have an indirect impact, especially as these counterparties in these large OTC sales start buying Bitcoin on the open market to satisfy that demand. As it so happens, it looks like this could start happening more and more, and that's because the supply of Bitcoin on OTC desks is at its lowest level in years, and that's at least according to the OTC desks Glassnode could identify. It's worth keeping in mind that the entire OTC market can be opaque, so it's hard to track on-chain. Even so, this doesn't change the fact that the on-chain indicators tracking supply of Bitcoin on OTC desks are likely directionally correct. In other words, the OTC supply could be higher than meets the eye, but it doesn't change the fact that this supply is on the decline. In case it wasn't clear enough, this decline in OTC supply will force OTC desks to buy Bitcoin on the open market, and that of course will push up its price. It's also worth noting that the main reason why the supply of Bitcoin on OTC desks has been declining is because Bitcoin miners have adopted a HODL strategy in recent years. Logically, large Bitcoin miners are the largest source of new Bitcoin supply. The fact that many of them have decided to HODL rather than sell their mined Bitcoin has therefore significantly restricted Bitcoin's available supply. But that's just the OTC side of the story. To quickly recap, most Bitcoin buys have been happening OTC, which has a minimal direct impact on Bitcoin's price. Meanwhile, lots of long-term Bitcoin holders have been selling Bitcoin on the spot market. Notably, this spot selling has been high ever since Bitcoin hit the $100,000 mark. And this is not surprising, given that 100K is a key psychological level that many long-term holders have probably had in mind for years. The result is that they've been consistently taking profits around the 100K level, partially through the spot markets, and unlike the OTC buys, these spot sales have directly impacted Bitcoin's price. Specifically, spot Bitcoin sales by long-term holders have been suppressing its price, which is something that almost everyone has noticed. Every time Bitcoin rallies up towards 100K, it struggles to get above that level, no matter how much strategy buys OTC, because Bitcoin whales are selling on spot. The silver lining, pun intended, is that the supply of Bitcoin held by whales has been on a sharp decline over the last 6 months or so. It's impossible to know when their spot selling will stop, but the spot selling is slowing, and the trend in OTC balances suggests more spot buys are coming. And if you're looking to trade Bitcoin or are trading Bitcoin already, then check out the CoinBureau Deals page down below. That's where you'll find sign-up bonuses of up to $100,000, trading fee discounts of up to 50%, and cashbacks on deposits of up to 75% on the best crypto exchanges around. You see, these deals, they won't be around for long. So take advantage of them ASAP by scanning this QR code or the link in the description. Back to the vid. So, when could Bitcoin's supply crunch occur, and how high could BTC's price go? The answer to the former ultimately depends on how much investors are willing to hodl Bitcoin as its price continues to climb. In other words, Bitcoin's supply crunch depends mainly on hodlers, not the buyers or sellers per se. In turn, the willingness of investors to hodl Bitcoin fundamentally depends on whether they see it as a risk asset or a safe haven. Right now, most investors still see Bitcoin as a risk asset, but more and more are starting to see it as a safe haven, particularly after it temporarily decoupled from stocks after the tariff kerfuffle. And if you watched our video about Bitcoin's decoupling, you'll know we underscored the fact that most investors will only see Bitcoin as a safe haven asset once there's something that makes them believe this. For example, a central bank announcing that it's holding Bitcoin, which could happen in the coming months. Alternatively, the catalyst that makes investors see Bitcoin as a safe haven asset could be as straightforward as Bitcoin decoupling from stocks for a sustained period of time, something that could also happen again in the coming months. And this would make ETFs, countries, and other large Bitcoin holders much less likely to sell. Even if this catalyst never comes along, the fact of the matter is that more and more of Bitcoin's supply is flowing from the weak hands to the diamond hands. And this means that there's less and less liquid Bitcoin. And that means that a supply crunch is likely inevitable, regardless of what happens in the coming months. Now, the answer to the latter question is truly fascinating, because The silver supply squeeze of the 1980s gives us a sense of how high Bitcoin could go if it experiences a supply squeeze of its own. The reason why this is so fascinating is because prior to the supply squeeze, silver followed a regular cycle of its own. As you can see, silver had a 6-year cycle throughout the 1960s and 70s. You'll notice that there were 3 cycles in total, and that the third time silver retested that long-term resistance trend line, it went parabolic. As you might have guessed, that parabolic move was driven by a silver squeeze. If you look at Bitcoin, you'll notice that there have also been 3 cycles in the 2010s and 2020s. The difference is that these cycles are 4 years instead of 6 years. The similarity is that Bitcoin is likewise retesting a long-term resistance trend line, and this is effectively happening at the time of making this video. At first glance, you might think, hey, history is unlikely to repeat, and that it's unlikely that Bitcoin will go parabolic if it manages to break above this long-term trend line. Upon closer inspection, however, you realize that this is more likely than meets the eye, and not just because of the similarities in supply. As we've learned, many consider Bitcoin to be a digital gold with a higher volatility. In practical terms, this means that they see Bitcoin as a higher risk, higher reward bet on gold. What was that historically? That's right, silver. So, even though Bitcoin's narrative is digital gold, investors treat it more like a digital silver. To put things into perspective, silver pumped by more than 4 times after it broke above that long-term resistance trend line in its third cycle, thanks to the supply crunch. But before you get too excited, it's important to note that silver's market cap back then was much smaller than Bitcoin's is today. Based on our research, silver's market cap was roughly $1 trillion in 2025 dollars before it went parabolic, meaning its market cap grew from $1 trillion to $4 trillion. If we assume that Bitcoin follows silver in market cap, then a $4 trillion market cap would translate to a Bitcoin price of somewhere around $200,000. There are just 2 important things to note, however. The first is that this assumes that Bitcoin experiences a supply crunch, which is by no means guaranteed. The second is that investors are likely to take profits ahead of 200K, and that's just because it's another key psychological level, meaning Bitcoin could top somewhere around 180K. Conversely, whales could push Bitcoin's price above 200K to suck in investors looking for that 300K plus level. And this brings me to the question of how a Bitcoin supply squeeze could affect the broader crypto market. In this case, the answer depends on how much of this Bitcoin gets used as collateral for borrowing in CeFi and DeFi. Now, to bring you up to speed, the amount of wrapped Bitcoin has been growing exponentially. You'll recall that almost 170,000 BTC are held in DeFi protocols. Now, for reference, that's around 0.8% of BTC's supply. And it's not far off from how much BTC was wrapped at the peak of the previous bull market. Obviously, most of this wrapped BTC is being used as collateral in DeFi. Holders are using this Bitcoin as collateral to borrow stablecoins, usually to invest in other cryptos, aka altcoins. And if you watched our video about wrapped Bitcoin, you'll know that we estimated that we could see up to 1 million BTC wrapped on various chains in this cycle. Assuming a Bitcoin price of over $100,000 or more, that could work out to a whopping $100 billion of BTC or more being used as collateral. In turn, this could translate into tens of billions of dollars of stablecoins being borrowed and invested into altcoins. Notably, both of these figures could be much higher if more investors start seeing Bitcoin as a safe haven asset, and the result would be more and more people using Bitcoin as collateral in this manner. After all, why would you sell your Bitcoin if it was being accumulated by central banks and held by governments? It would make more sense to borrow against it if you need extra money. And if you're a Bitcoin maxi, maybe you'll use this Bitcoin to borrow even more to buy more Bitcoin, pushing its price up even further. All this would do is further increase the amount of crypto-native liquidity, and the secondary effects of this could be quite profound. I suppose that wrapped Bitcoin holders use their Bitcoin collateral to borrow stablecoins and buy ETH. This would cause ETH's price to rise, and that would of course deter Ethereum maxis from selling ETH and motivate them to use it as collateral in DeFi, borrowing stables against their ETH. In sum then, A supply squeeze would result in an increase in crypto-native liquidity due to the positive impact it would have on Bitcoin's price and the increased amount of borrowing that would occur against Bitcoin as a result. And this could cause many cryptos to experience parabolic moves of their own. But of course, none of this is sustainable. Eventually, someone will start selling Bitcoin, and a low supply of liquid Bitcoin means that this sell pressure would have an outsized impact on price on the way down, just like the buying pressure on the way up. And this would trigger liquidations in DeFi and CeFi, as well as on exchanges where traders who went long would get liquidated, pushing prices down further. Because most crypto investors see Bitcoin as a safe haven, many would begin selling their other altcoins and rotate into Bitcoin, both out of caution and to stack more sats. This would likewise result in a wave of liquidations in DeFi, CeFi, and on exchanges as those who went long ETH, Sol, and other cryptos used as collateral get wrecked. All the while, the supply of stablecoins would contract massively as people cash out. And this would force stablecoin issuers to sell the collateral back in the stablecoin tokens, which is mostly US government debt, i.e. US bonds. And because US bonds are the backbone of the financial system, a massive sell-off in US bonds to meet stablecoin redemptions could create broader financial instability. If this somehow triggers a major stablecoin to depeg, it could amplify the liquidation-driven crypto crash. Believe it or not, but this wouldn't be that different from what happened to silver after the 1980s squeeze. The catalyst that caused silver to collapse was a change to rules around purchasing commodities using leverage. Because the Hunt brothers had financed most of their silver purchases using leverage, silver crashed on the realization that they could no longer buy, and eventually they got liquidated. Although silver did rally later in 1980, it didn't come close to its all-time high of just under $50 and has yet to reclaim that all-time high more than 5 decades later. In retrospect, it's easy to see why. The leverage mechanisms that allowed silver to rally so much were practically made off limits. Fast forward to today, and it's easy to see how history could repeat again with Bitcoin. We could see a massive melt-up to an unprecedented all-time high because of a supply shock, only to see Bitcoin fail to reclaim this new epic high for years, possibly decades. Again, this would just be because the same leverage mechanisms that made this massive rally possible would be made off limits. While there's no guarantee that we would see the same kind of restrictions on Bitcoin leverage like we did with silver in the 1980s, it's almost guaranteed that traders and investors would be aware of these dynamics. Put differently, they would know when entities are starting to take on unsustainable amounts of debt to buy Bitcoin, and they would try and liquidate these entities to make a profit shorting BTC. Similarly, investors would be unlikely to buy the debt being issued because they know how the story would end. And this would make it very hard to see a repeat of what we're seeing today, like publicly traded companies issuing billions of dollars of debt or shares to buy Bitcoin using all kinds of financial magic. And that reminds me, I'd be remiss if I didn't mention an intriguing possibility that some Bitcoin analysts have raised, and that's that publicly traded companies are pulling forward the effects of Bitcoin's future halvings. And this is because they're literally restricting the supply of newly mined Bitcoin, like the halving effectively does. If this is correct, then it stands to reason that this is also pulling forward the effects that future halvings would have on Bitcoin's price and result in the dynamic I just mentioned. Bitcoin rallies way more than expected in this cycle because of the supply crunch, and rallies less in the next cycle, both because the same amounts of leverage demand won't be possible and because the supply effects were pulled forward. With all that said though, the bigger and more imminent risk to Bitcoin is a potential fork resulting from something like a quantum computing threat, and you can learn more about that in our video right over here. And if you're not subscribed to the channel yet, you can do that right over here. This is me, Nick, signing off. Thank you very much for watching, and I'll see you again soon.